If you want to build real wealth, if you want to catch the big money moves before they happen, you need to understand how the game works at a fundamental level. You can't just rely on what other people are saying. You can't just chase headlines. You've got to learn to look at the mechanics, the cause and effect relationships that drive markets. That's where the big opportunities come from. Now, let me ask you something. When you see a chart moving, do you ever stop and think, why is it moving? Not just that it's going up or down, but what's actually driving that shift in price? Because if you don't know, you're not really trading, you're just guessing. And guessing isn't a strategy. Big money moves, the kind that really matter, don't come out of thin air. They happen because of imbalances. Buyers overwhelming sellers, or sellers overwhelming buyers. And if you can read the signs of those imbalances forming early, before the crowd jumps in, that's when you can position yourself to capture outsized gains. Here's the thing. Most people focus on the news. They wait for an announcement, some earnings report, or a central bank headline. But by the time you're reading the news, the big players have already positioned themselves. They saw it coming because they pay attention to the underlying forces, the cycles, the liquidity, the sentiment shifts. That's what you've got to learn to recognize. Think about it like this. The market is just a machine. It runs on inputs and outputs. Inputs are things like interest rates, credit availability, supply and demand. Outputs are the price movements you see on a chart. If you can track the inputs, you can often anticipate the outputs. Makes sense, right? Now let's talk about charts. People sometimes dismiss chart reading as just drawing lines and guessing. But charts are simply a picture of human behavior. Every candle, every bar, it's the sum of fear and greed. And if you learn to read that picture, you can see when something big is about to shift. For example, think about volume. Price without volume is like words without conviction. If you see price moving in one direction, but volume isn't backing it up, it's usually not sustainable. But if you see a breakout with heavy volume, that tells you real money is behind it. And real money leaves footprints. Do you follow footprints when you want to know where someone's going? Of course you do. Same thing in trading. Another key signal is structure. Markets move in trends and ranges. When you see a range forming, that's the market building energy. Think of it like a spring being compressed. The longer the range, the bigger the breakout when it finally moves. And if you can catch the early signs of that breakout, that's where the big money is made. But here's the challenge. Most people get trapped by emotions. They see a breakout and they jump in too late, right when the professionals are already selling to them. They chase moves because they want certainty. But certainty doesn't exist in markets. All you can do is tilt the probabilities in your favor. That's why mindset is so important. Let me ask you this. When you lose a trade, what's your first thought? Do you blame the market, or do you ask what signals you missed? Because if you blame the market, you're giving away your power. But if you take it as feedback, you're learning how to read the game better next time. Building wealth as a trader isn't about catching every move. It's about catching the right moves, the ones with asymmetry, where your downside is small but your upside is large. That means waiting patiently like a hunter. You don't chase every rustle in the bushes. You wait until the conditions line up, and then you strike. Let's go deeper into how you actually spot these early. Start with higher time frames. Look at the weekly or monthly chart. That's where you can see the big picture, the major trends. Then drop down into the daily or even hourly to time your entries. The mistake people make is they only focus on the small time frames. They get caught in the noise. But the big money moves come from aligning with the bigger trend. For instance, if the weekly chart is showing higher highs and higher lows, you know the market is in an uptrend. Then, if you see the daily chart pulling back into a strong support level with volume drying up, that's often a signal that the next leg higher is about to start, and you're positioning yourself before the crowd jumps back in. Do you see how this is about stacking probabilities? You're not predicting the future with certainty. You're reading the clues like a detective. The more clues line up, the higher your edge. And over time, That edge compounds into real wealth. Another powerful concept is divergence. Sometimes you'll see price moving one way, but momentum indicators like RSI or MACD moving the opposite way. That's a signal of weakening strength. For example, if price is making new highs, but momentum is making lower highs, that tells you the trend may be losing steam. And when that happens at a major resistance level, it often leads to a reversal. Catching those reversals early can be incredibly profitable. But here's what separates average traders from those who actually build wealth. It's not just seeing the setup, it's managing risk. Because no matter how good a setup looks, you're going to be wrong sometimes. The question is, do you survive being wrong? If you risk too much on one trade, you can wipe out months of progress. That's why disciplined position sizing is critical. Think about it like running a business. Would you ever put all your capital into one customer, one deal, hoping it works out? Of course not. You'd diversify, you'd manage your exposure. Trading is the same. You've got to survive long enough to let the law of large numbers work in your favor. And that ties back to mindset. Because the real battle in trading isn't against the market, it's against yourself. Fear makes you cut winners too early. Greed makes you hold losers too long. Patience feels boring, but it's the key to catching the big moves. Ask yourself honestly, do you want excitement or do you want wealth? Because they're not the same thing. Now let's talk about cycles. Everything in markets moves in cycles. Expansion, peak, contraction, bottom, and repeat. These cycles happen in the economy, in industries, even in individual stocks. If you can identify where we are in the cycle, you can position yourself accordingly. Are we in a phase where credit is expanding, fueling growth? Or are we in a tightening phase where liquidity is drying up? That matters because liquidity drives markets more than news stories ever will. Take credit cycles. When interest rates are low and money is cheap, asset prices tend to rise because people can borrow more and take more risk. But when rates rise, borrowing gets more expensive, risk appetite shrinks, and asset prices often fall. Do you see how simple that is? It's not about complicated predictions. It's about understanding cause and effect. And here's where chart reading connects to macro. The big players, institutions, hedge funds, central banks, they move based on these cycles. Their actions leave footprints on the charts. That's why you'll see distribution phases at market tops, where price goes sideways but volume is heavy, because the smart money is selling into strength, while the crowd is still buying. If you learn to recognize that distribution, you can avoid being the one holding the bag. Let me ask you something else. When you look at a chart, do you only see price, or do you think about the psychology behind it? Because behind every candlestick is a human decision. Fear of missing out, fear of losing, hope, greed, that's what creates the patterns. And if you understand the psychology, you can anticipate what comes next. For example, think about support and resistance. Why do those levels matter? It's not magic. It's because human memory is sticky. If a lot of people bought at a certain price and the market drops, when it comes back to that price, they want to sell to break even. That creates resistance. On the flip side, if many sold short at a level and price goes higher, they want to cover when it comes back down, creating support. It's all just behavior, and behavior is consistent enough to trade. But you can't just memorize patterns. You've got to combine them with context. A head and shoulders pattern doesn't mean much if it's against the dominant trend. A breakout isn't reliable if volume doesn't confirm. Context is everything. And that's where disciplined observation comes in. This is where the mindset of wealth building overlaps with trading. Wealth doesn't come from one lucky break. It comes from stacking small edges consistently, protecting your downside, and compounding over time. The same principles apply to trading. You don't need to catch every single move. You need to catch the ones that matter, protect your capital when you're wrong, and let your winners run when you're right. Now, think about your own trading approach. Are you playing defense as much as offense? Because defense is what keeps you in the game long enough to see the big opportunities. Without capital, there's no opportunity. So the number one rule is don't lose so much that you can't come back. That's why stop losses matter. That's why position sizing matters. That's why discipline matters. And yet, you've also got to think big when the conditions are right. The biggest mistake I see traders make is being too cautious when the perfect setup comes. They spread themselves thin across too many mediocre trades instead of focusing size on the few high-quality opportunities. That's how big money is made, by pressing the edge when it's truly there. Here's a practical way to approach it. Build a checklist for your trades. Does the setup align with the higher time frame trend? Is there clear support or resistance nearby? Is volume confirming? Are momentum indicators in agreement? Is the risk-reward ratio at least 2 to 1? If you can't check those boxes, pass on the trade. If you can, that's when you consider increasing size. Do you see how this takes emotion out of it? You're not relying on feelings. You're relying on rules. And rules protect you from your own biases. Because left unchecked, your mind will trick you. It'll make you see patterns that aren't there, make you chase when you should wait, make you hold when you should cut. Rules are your safeguard. Over time, this way of thinking changes how you see money itself. You stop chasing quick wins and start respecting compounding. You start treating every dollar as a soldier, one that you don't want to lose needlessly. You deploy those soldiers strategically into battles where the odds are in your favor, and slowly but surely you build an army. That's wealth building. And here's something most people don't realize: wealth is built in silence, not in noise. The loud trades, the flashy gains, they usually come with equal risk on the downside. The steady, patient compounding of well-chosen trades, that's where real wealth comes from. Ask yourself, are you chasing noise, or are you building signal? Now, when you catch a big move early, and you will, if you keep practicing, the temptation will be to take profits too quickly. But remember, the big money isn't in the entry, it's in the holding. The hardest thing in trading isn't buying or selling. It's sitting still when you're right. That's why having a plan is critical. Decide in advance where you'll take partial profits, where you'll trail your stop, where you'll let the rest ride. That way, you're not making emotional decisions in the moment. This ties back to discipline. Discipline isn't just about cutting losses. It's about holding winners. It's about doing what your plan says, even when your emotions scream otherwise. And that's why trading is one of the greatest teachers of wealth building. It forces you to confront yourself, your habits, your psychology. So here's the real takeaway: catching big money moves early isn't about luck. It's about preparation. It's about reading the cycles, the charts, the psychology. It's about stacking the odds in your favor, managing risk, and letting compounding work for you. And if you can do that consistently over time, the wealth takes care of itself. Now, think about this. If you had the discipline to focus on just a few high-quality opportunities each year and manage them well, how different would your trading results look? Would you still feel the need to chase every move? Or would you have the patience to wait for the real ones? Because at the end of the day, the market rewards patience, discipline, and understanding. And the earlier you internalize that, the faster you'll separate yourself from the crowd. Charts are footprints of fear and greed. Learn to read them. That simple statement captures one of the deepest truths about markets, and yet most people overlook it because they get caught up in the surface-level noise. When you see a chart, what you're really looking at is not just price, not just numbers ticking up and down. You're seeing the collective behavior of millions of participants, all responding to their own emotions, incentives, and biases. Every candle on that chart is a snapshot of psychology. Fear, greed, hesitation, overconfidence, it's all baked into the movements. And if you can learn to interpret that language, you can see what's happening beneath the surface long before it becomes obvious in the headlines. Think about what drives people to buy or sell. On the way up, greed fuels the move. Traders and investors see others making money, and they don't want to be left out. They feel the fear of missing out, which is still a form of fear, but it pushes them into buying higher than they would normally be comfortable with. On the way down, fear takes over in its purest form. The fear of losing becomes so overwhelming that people dump their positions at any price just to stop the pain. Charts make these waves visible. An uptrend with strong candles and rising volume. That's greed spreading through the market. A sudden plunge with panic selling. That's fear flooding the system. Let me ask you something. When you look at a breakout on a chart, do you only see lines being crossed? Or do you think about the emotional story that got us there? Because behind that breakout is a crowd of traders who were waiting, uncertain, until the momentum pushed them off the sidelines. That collective shift shows up as a surge in price. When you think of charts as maps of behavior rather than static shapes, you start to understand why certain patterns repeat over and over across decades, across asset classes, across geographies. Human behavior doesn't change much. This is why support and resistance levels matter. They're not just arbitrary lines drawn on a chart. They're markers of memory. Imagine a group of traders who all bought at a certain level, and then price dropped. They've been sitting on losses, waiting, hoping for price to come back so they can get out without pain. When it finally returns to that level, they sell, creating resistance. The opposite happens with support. People who shorted at a level and got squeezed wait for price to fall back down to cover their positions, creating demand. That's not magic. That's human psychology repeated over and over, and charts simply give you a way to visualize it. Another way fear and greed show themselves on charts is through volume. Price movement without volume is often like empty words without action. But when you see a breakout supported by heavy volume, you're witnessing conviction. Real money is stepping in. That tells you that the move has fuel behind it. On the flip side, if you see price grinding higher on declining volume, that's greed pushing without enough backing. It's a signal that the move could stall out. The footprints left by volume tell you how strong the underlying emotions are. Now, patterns like head and shoulders, double tops, flags, triangles, these aren't just artistic drawings. They're recurring expressions of human behavior. A flag pattern, for example, often appears when a strong move pauses because traders take profits while others wait for confirmation before entering. When the pattern resolves, you get another surge as the hesitation breaks. Do you see how that's really about psychology, not just shapes? If you can interpret it like a story, you'll see more clearly what's driving the market. Think about long consolidation phases. What's happening there? It's indecision. Buyers and sellers are testing each other. Neither side has enough conviction to take control yet. But the longer that battle drags on, the more tension builds. And when one side finally wins, the breakout tends to be powerful because it represents the release of all that pent-up energy. You can't see that in the news. You can't always feel it in sentiment surveys. But you can see it in the chart. And then there are false breakouts, which can be even more revealing. A false breakout happens when price pushes through a level, tempting traders to chase, and then quickly reverses. What's happening there? Greed lures people in, but the professionals use that moment to sell into them. The crowd buys the breakout, thinking it's safe, and then gets trapped. Fear kicks in, and they sell at a loss. The chart captures this dance between amateurs and professionals, and once you understand it, you can avoid being on the wrong side of it. You might ask yourself, why do these patterns and footprints matter if markets are supposed to be efficient? The answer is simple. Markets are efficient over the long term, but in the short term, they're ruled by emotions. And because emotions are predictable, patterns repeat. Efficiency doesn't erase psychology. It only balances it out over time. In the day-to-day, fear and greed dominate, and charts show you the evidence. This is why some of the best traders rely heavily on price action. They're not just drawing lines for fun. They're studying behavior. They're asking, what are traders thinking at this level? Who's trapped here? Who's in pain? Who's feeling confident? When you analyze a chart this way, you're not forecasting based on wishful thinking. You're piecing together a logical story of human behavior. Let me ask you another question. When you see a sharp spike on a chart, do you ever wonder who just got forced out of a position? Because spikes often represent forced liquidations, margin calls, stop losses being hit. That's fear on full display. And right after that spike, when the forced selling is done, you often see strong reversals because the pressure is released. The chart doesn't just show price, it shows stress and relief, panic and calm. Greed, on the other hand, tends to build gradually. You'll see steady climbs, small pullbacks, dips being bought quickly. The crowd grows more confident. They stop worrying about risk. Then suddenly, when everyone is on one side of the boat, a sharp reversal can occur because there's no one left to buy. That's greed reaching its peak. And again, the chart tells the story. Divergences, weakening momentum, heavy volume at the top, all signs that greed has gone too far. This is why discipline matters when reading charts. It's not about predicting perfectly. It's about interpreting probabilities. If you see greed getting out of control, you know the probability of a reversal is rising. If you see fear creating capitulation, you know the probability of a rebound is higher. You're reading footprints and adjusting your behavior accordingly. The more you practice this, the more you realize that markets aren't just numbers on a screen. They're a living reflection of collective psychology. That's why the same patterns show up in different decades, in different markets, in stocks, commodities, currencies, even crypto. Human fear and greed haven't changed for thousands of years, and as long as humans trade, those footprints will be visible in the charts. By training yourself to see beyond the surface, you start to develop an instinct for when something is real and when it's just noise. You stop chasing every move and instead wait for the signals that tell you where fear and greed are tipping the balance. And that's how you catch the big money moves early, not by guessing, not by hoping, but by reading the footprints that human behavior leaves behind on every chart. Higher time frames reveal the big trend, lower time frames refine entries. This idea sounds simple on the surface, but it's one of the most powerful principles a trader can internalize. Most people come into trading and zoom right into the smallest charts. They want action, they want movement, they want to feel like they're doing something. 5-minute candles, 1-minute candles, sometimes even tick charts. But here's the truth, if you only live in those small time frames, you're seeing noise more than signal. You're reacting to randomness, not structure. And when you build decisions on randomness, the odds of consistency go way down. Now let me ask you something. If you were navigating across the ocean, would you start by staring at the tiny ripples in the water? Or would you first look at the map of the coastline? You'd look at the map. You'd want the big picture of where you're headed. That's what higher time frames give you in trading. They show you the map, the broader trend, the direction that actually matters. Once you know that, then you can drop down to the smaller charts to figure out the precise timing. Without the map, the ripples just confuse you. Think about what happens on a weekly chart. Each candle represents 5 trading days. Patterns that emerge there are showing you how price has behaved across hundreds of thousands, sometimes millions of transactions. There's a lot more information packed into those candles. A breakout on the weekly carries far more weight than the same breakout on a 5-minute chart. It represents conviction across more participants. That's why big money, institutional money, always looks at higher time frames first. They're not scalping for a couple of ticks. They want to align with the larger flow of capital. When you zoom into a daily chart after studying the weekly, you start to see the mechanics of how the big trend is unfolding. If the weekly shows higher highs and higher lows, a classic uptrend, then on the daily you can look for pullbacks into support or flags consolidating before another leg higher. Those daily structures give you the setups to participate in the bigger move. You're trading in harmony with the tide, not against it. And that distinction matters more than most people realize. Here's where the refinement comes in. Once you've identified the trend on the weekly and the structure on the daily, you can drop down further into the 4-hour, 1-hour, or even 15-minute to time your entry. That's where you can be precise. You can wait for volume to confirm, or for a breakout of a smaller consolidation, or for a momentum shift. By aligning the small time frame entry with the large time frame trend, you're stacking probabilities. And in trading, probabilities are everything. Do you see how this approach protects you from a lot of common mistakes? For example, many traders get excited about a breakout on a 15-minute chart, but they don't realize it's breaking directly into resistance on the daily. That move is likely to fail. If they had started with a higher time frame, they would have seen that the path was blocked, or the opposite, they panic when they see a small pullback on a 5-minute chart, but on the weekly, it's just a minor retracement in a strong uptrend. If they only focused on the small view, they'd cut a good trade too early. The bigger time frame gives you context, and context keeps you grounded. There's also something deeply psychological about higher time frame analysis. It forces you to slow down. It pulls you out of the mindset of constant reaction. When you study the weekly and monthly charts, you realize that the real wealth building moves don't happen in minutes. They happen across weeks, months, sometimes years. That shift in perspective changes how you approach trading. You stop chasing every little move and start positioning yourself for the ones that matter. Let me give you an example. Suppose you're looking at a stock, and on the weekly chart, you see it's been basing for months, forming a large consolidation right under a major resistance level. Volume has been gradually increasing, and momentum indicators are showing strength. That's the big picture. Then, on the daily, you notice the stock is making higher lows into that resistance, a sign that buyers are becoming more aggressive. Finally, on the 1-hour chart, you see a breakout with strong volume. That's your entry. You didn't just buy randomly. You aligned 3 layers of information: the higher time frame trend, the intermediate structure, and the precise trigger. That's how professionals approach it. Contrast that with someone who only looks at the 1-hour chart. They see the breakout, they buy in, but they have no idea that just above on the weekly, there's a massive resistance from 2 years ago. As soon as price hits that level, it reverses sharply. The short-term trader gets stopped out, frustrated, thinking the market tricked them. But it wasn't the market, it was their lack of perspective. They didn't zoom out far enough to see the wall in front of them. The same applies in reverse. On the weekly, maybe you see a strong downtrend, lower highs and lower lows stretching back a year. On the daily, there's a small bounce. On the 1-hour, you see the bounce breaking upward, and you're tempted to chase. But if you understand the bigger picture, you know that bounce is just a counter-trend rally in a broader bear market. The probability is higher that it will fail, and if you take a short, you're aligning with the major trend. That's how you avoid being trapped by false optimism. Let me ask you this. Do you want to be trading with the tide or against it? If you're surfing, do you paddle with the waves or into them? The answer is obvious, yet so many traders ignore it in practice. They fight the higher time frame trend because they're seduced by the small swings. But fighting the tide is exhausting. Aligning with it is far more sustainable. This principle also applies to risk management. When you're trading with the higher time frame trend, your stop loss can be set more logically. You can place it below a significant weekly support or above a major resistance rather than in arbitrary spots. That gives your trade more room to breathe, while still being grounded in structure. You're not just hoping the market respects your line, you're positioning based on where the big players are likely to defend their positions. Another important point is that higher time frames smooth out noise. On a 5-minute chart, you'll see constant wicks, false signals, and fake breakouts. It's easy to get chopped up if that's all you look at. But on the weekly, those wicks barely register. What looks chaotic on the small view often becomes orderly on the larger view. And when you train your eyes to see that order, you stop being shaken out by every little fluctuation. This is why top-down analysis, starting big and working small, is so powerful. It mirrors how capital actually flows. Big institutions don't base their decisions on 5-minute candles. They allocate based on quarterly performance, annual cycles, economic trends. Their footprints are visible on the higher charts. And once they commit, their moves cascade down to the smaller time frames. By aligning with that, you're essentially following the trail of the elephants, not chasing the footsteps of mice. So the process becomes systematic. Begin with the monthly or weekly to understand the dominant trend. Drop into the daily to identify structure and potential areas of interest. Then zoom into the 4-hour or 1 hour to refine your timing and execution. Each step informs the next, and the alignment across time frames is what gives you confidence. It's not about being right all the time. It's about trading in the direction where probabilities are already tilted in your favor. Think about how this applies to wealth building. If you only trade short-term moves, you might make small gains here and there, but you'll also take frequent losses. It's hard to build wealth that way because the noise eats into your profits. But if you anchor yourself in higher time frame trends, you can capture the moves that really matter. Those are the ones that compound. And when you refine your entries on the lower time frames, you can do it with smaller risk and larger potential reward. That's asymmetry. That's where the edge is.